Welcome to the Daily Block, the top events happening in past day in crypto and why they matter. Fast, snarky, and painful, like your last trade. US government shutdown risks delaying crypto policy and ETF approvals. Congress blew past the October 1st funding deadline and triggered a partial federal shutdown. Committee work and agency staffing slow to a crawl, which means the SEC, CFTC, and other rulemakers have less runway to publish guidance, hold hearings, or finish ETF sign-offs. That doesn't pause markets, but it pauses the paperwork that typically unlocks big institutional flows and clarity. Expect calendar risk and headline-driven volatility until Congress reopens the lights. Why it matters for crypto investing. A prolonged shutdown delays time-sensitive catalysts like ETF approvals, increasing uncertainty that can choke institutional inflows or temporarily lower enforcement. Both can swing short-term prices. Risk counterpoint. If the shutdown is short, pent-up decisions could batch up and create a furious spike of announcements when staff return. So don't assume no news equals no move. On to Bitcoin, which is doing the classic October flex. Bitcoin popped about 3% back above $116,000 a seasonal. October optimism met reported spot ETF inflows on September 30th. The rally came with monster liquidations, north of $600 million in 24 hours, which tells you leverage was babysitting the move and got smacked. ETF flow headlines plus this kind of liquidation footprint mean every price nudge can cascade into a squeeze or a violent retrace. Watch ETF inflow reports and clustered leverage zones because that's where the market explodes. Why it matters for crypto investing. BTC price action combined with ETF flows is the primary engine for altcoin rotations and liquidation cascades, so tracking flows and leverage clusters helps anticipate big intraday moves. Risk counterpoint. Short-term strength can invite fresh leverage, which increases crash risk if sentiment flips. Conversely, steady ETF demand could normalize volatility over time. Solana's Firedancer team wants to uncap blocks after Alpenglow. ETF chatter heats, so will demand. Jump's Firedancer crew proposed removing block limits post-Alpenglow to massively boost throughput, and that technical story is colliding with fresh ETF and validator chatter around Solana. Traders and funds are sniffing around for entry as upgrade optimism meets potential listing narratives. If Firedancer actually raises sustained TPS without breaking the network, Solana's utility and TVL narratives get a real boost, but upgrades at this scale are complex and can introduce bugs or centralization trade-offs that short-term traders will overreact to. Why it matters for crypto investing. Credible throughput improvement plus ETF speculation is a classic volatility multiplier that can rapidly re-rate SOL if adoption or metrics follow through. Risk counterpoint. Implementation risks and governance pushback could delay benefits or cause temporary network instability, creating fast downside for levered longs. Metaplanet stacks another massive chunk of Bitcoin on its balance sheet. Japanese firm Metaplanet disclosed roughly 5,268 BTC purchases totaling about 91.6 billion yen, which is roughly $623 million, pushing their reported holdings toward the 30,000 BTC neighborhood. They're funding buys with capital raises and preferred shares, which means corporate accumulation is still very much the meta play. Large corporate buys permanently remove supply from the market and signal institutional appetite, which in turn supports price floors and squeezes shorts. The counterpoint is balance sheet risk and market timing. Big buyers can also sell into rallies if capital needs change. Why it matters for crypto investing. Continued corporate treasury accumulation reduces available float and is a structural bullish input that can support sustained rallies and pressure short positions. Risk counterpoint. Corporate buyers aren't long forever. They can liquidate or hedge, and concentrated holder dynamics can increase volatility if a holder changes strategy. Coinbase hits $1 billion in on-chain loan originations. Leverage layer grows. Coinbase's BTC collateral lending product on Base via Morpho surpassed $1 billion in originations and shows about $1.45 billion locked as collateral. Retail LTVs tend to sit in the 30 to 40% range, which is conservative on paper, but platform liquidation mechanics and warning triggers remain real escalation paths if BTC drops fast. This creates a chunky leverage slab off exchange that can amplify downdrafts and send ripple liquidations through the on-chain ecosystem. Keep an eye on borrowed volumes and collateral valuations because rapid deleveraging is a known market igniter. Why it matters for crypto investing. Growing BTC-backed loans add a leverage layer that can magnify volatility and contribute to cascade liquidations on sharp price moves. Risk counterpoint. Lower typical LTVs provide some buffer, but liquidity stress or coordinated redemptions could still force levered exits. Tether and Rumble roll out a US stablecoin and wallet push. Tether announced a US-facing stablecoin called USAT to be distributed through Rumble's upcoming US crypto wallet. Rumble claims about 51 million monthly active users, and Tether has a big stake in the company. Tether tapped a US lead to shepherd USAT under new federal stablecoin rules, which suggests they're aiming for mainstream on-ramps rather than black market plumbing. If USAT finds traction inside a social app with tens of millions of users, that's a fresh conduit for fiat into crypto markets and could reshape stablecoin market share and liquidity pathways. The obvious catch is regulatory scrutiny and user trust. Adoption is not automatic just because the platform has lots of eyeballs. Why it matters for crypto investing. A major stablecoin distributed through a large consumer platform is a potential new on-ramp that can change flow dynamics in liquidity distribution across exchanges and DeFi. Risk counterpoint. Regulatory pushback or slow user adoption would blunt the impact, and political attention could make USAT a lightning rod. BNB Chain's official X account was compromised and served up phishing links. The verified BNB Chain X account got hijacked and posted malicious links promising rewards, reportedly netting between $8,000 and $13,000 in direct thefts, with many more narrowly avoided, thanks to vigilance. Users who blindly clicked Wallet Connect pop-ups and signed approvals were the ones who got peeled, which is the same rookie mistake from 2018, but with better memes. The account was restored, but social account takeovers still produce immediate wallet drain waves and market jitters. This is the kind of noise that can spark short-term panic selling or force hurried security audits by projects. Why it matters for crypto investing. Social compromises of verified accounts cause real wallet drains and short-term market disruptions, so assume any unexpected airdrop or reward post is a phishing attempt and don't sign unknown Wallet Connect requests. Risks counterpoint. Social platforms are improving security, but human error and credential reuse mean this will keep happening. Mitigate with hardware wallets and tight allowance checks. XRP ETF buzz reignites pre-sale mania and speculative token launches. With several SEC decisions on XRP-adjacent ETF filings due in October, institutional eyes are back on Ripple's universe, and that optimism spilled into pre-sales like the so-called XRP Tundra project, which markets dual tokens, staking yields, and anti-dump fees. That pre-sale noise ramps up on social channels and audits are being waved around like victory flags. But pre-sales are classic pump-and-rug playgrounds in front of big ETF news. ETF approvals or denials will be huge price catalysts for XRP and anything claiming adjacency. Pre-sales can moon quickly or vaporize faster. Why it matters for crypto investing. ETF docket outcomes are major catalysts for XRP, and speculative pre-sales ahead of those events carry extreme asymmetric risk and volatility. Risks counterpoint. Regulatory outcomes are binary and can wipe out narrative-driven pre-sales. Treat pre-launch tokens as highly speculative. Quick trading takeaways. Regulation timing is a calendar game. The US shutdown can delay ETF approvals and hearings, so watch committee headlines like a hawk. ETF plus upgrade combos equal high gamma. SOL and XRP are the two tokens most tied to near-term regulatory and technical catalysts. Leverage risk is real. Large liquidation clusters and more than $1 billion in loan originations mean quick BTC moves can cascade. Keep stops tight and size accordingly. On-chain flow watchers should track stablecoin issuance, ETF inflows, and corporate buys like Metaplanet as the cleanest early indicators of structural demand. If you liked that, smash subscribe for daily blocks of market receipts, on-chain receipts, and a little schadenfreude. That's today in crypto, where the gains are imaginary and the pain is real.